I know you know me. I know I'm a mellow guy. I'm pretty laid back. But baby, I am so psyched up today. Why am I psyched up? Bottom line, I'm talking to Bill Bodnar. Now, this guy, he knows numbers. He's a genius. He puts it all together. But better than that, he's a really good person and he's a friend of mine. Let me just tell you just real quick a little bit about his background because I've been in this business since 96. I don't know when he started, but he's back there with me because he started the MMG, the Mortgage Market Guide. He's a co-founder of that. You remember that? But he's evolved that MMG into a thing called Tabrasa. And what's Tabrasa? He's the CRO, Chief Revenue Officer. What they do is they take the CRM, so you can give all this information out. You can create videos, whatever it is. And what does he do? He gives you the knowledge based on the MMG, what's going to be out there and what the market's doing. Folks, I got to tell you, he sends out a video every single day and says, this is what the economics are looking like. This is what we're tracking in the economy and how it's going to affect the mortgage business. I watch it every single day. Bill, thanks so much for being here.
Thank you for having me, my friend.
Yeah, I hope I was enough of a hype man for you to get it started. So
that was amazing. And guess what? We have 14 minutes left.
So we're going to jump right into it. The number one word that I hear every single day, and everybody says, they say it on the news, they say it to me, hey, what's going on with the Fed? The Fed this, the Fed that. Let's talk a little bit about the Fed, shall we? First question is, what is the Fed? Why do we care? Because I know I've been told my entire life, hey, we got to watch the Fed, even though it doesn't affect mortgage rates directly. What's the Fed?
So obviously we have to follow the Fed. They do control monetary policy, and so they're going to influence short-term rates. And so what we have up on the screen is where to find this, right? So next week, and by the way, what is really remarkable is they hike and cut rates based on where the economy is going, and that is changing in real time right underneath our feet. I mean, right now we're talking about risks of a recession, and just 3 weeks ago, Fed said, hey, we're going to cut rates just one time for the rest of the year. Now there's actually a chance, as we sit here today, of 3 rate cuts this year. One in September, one in November, one in December. So where do you find this? Go to that link, save it in your browser. Right now, today, and there's even a chance of a Fed rate cut next week. And that was because we had a former Fed official come out yesterday and said, hey, the facts changed, I've changed. The Fed needs to do this now, cut next week, and avoid any further risks of a recession. So you got to follow the Fed. And big saying, don't fight the Fed. If they tell you things are going higher, look at, we've been going there. The great news, the next move is a cut, and we're probably going to get a series on them.
So, Toby, thanks for being here. Stephen, thanks for being here. We're having this call so you know it. Just so you know, you're going to get a copy of this deck afterwards. Why? There's going to be a lot of links. So if you want to track what the Fed is doing, it's going to be in the deck that's going to get sent out to you so we can follow it. All right, the Fed's a big one. We got it. Watch it. Even though it doesn't directly affect rates, rates tend to follow what the Fed says that they're going to do. No problem. But another word I hear, and gosh, is this all over the news today? Inflation, inflation, inflation. I'm shutting. You're talking. What are we doing?
Okay, so another timely slide. Tomorrow, the core personal consumption expenditure index, quite the mouthful, is going to get released. That number is currently running at 2.6% year over year. This is the reading. Whenever you hear the Fed wants inflation going to 2%, that's the number. Now they want it to move what they call sustainably towards 2%. Well, it was 5.5 not too long ago. It feels like it's moving sustainably. So I start to question, what are they looking at? Here's what I can tell you. If that number, because now we've had a whole run of bad economic news going into this inflation number, right? The Fed cuts and hikes rates based on inflation and outlook of the economy. The economy is decelerating. If this inflation number comes in at 2.5%, which is lower than last month, and that's at expectations, I think that brings forward the Fed rate cut in September. If it comes in line or at 2.6% with no further moderation, that's going to muck things up because Fed Chair Powell does not want to cut rates and risk having inflation kind of manifest and reaccelerate. So it's an important number. You have to watch it. And you have to manage your pipeline and your expectations in advance of it.
Let me just ask you a quick question. I'm looking at the chart on the screen. That's the PCE that you showed me, but that doesn't show 2.5%. What am I looking at?
Well, there's a couple different views. What that view is like over the long term. You can see that goes back 60 some odd years, right? So that's showing inflation growing over time. And if you look at the far right of the chart, you can see how it's gone parabolic, there's a nice smooth trend and it goes up sharply. that's like a 2-year kind of 12% wallop on PCE that really made people nuts.
Got it. Fantastic. So we just talked about the Fed. We just talked about inflation, and we got to talk about unemployment because everybody's talking about unemployment. It's really interesting because typically unemployment is the opposite of how when unemployment goes down, inflation sort of tends to go up. So tell me a little bit about unemployment and why we care about it for mortgages.
Well, it relates to the first slide. The Fed has a dual mandate. It's price stability and maximum employment. That's their job. But I got to take care of inflation, and I got to make sure that we have maximum employment. And so we have to remember that jobs buy homes. So all of us in the mortgage and housing world are wanting, begging, praying for lower rates. But it can't come at the expense of a material increase in unemployment because jobs buy homes. Steve, I love you. I love your mortgage company. I love the house, and I love the rate. But if I don't have a job or I'm in fear of losing my job, I can't do the deal. So let's be careful with how much unemployment we get. That number comes out next week. And you can see the theme. If you understand this stuff, you have something relevant and timely to talk about each and every week. This week's about inflation. Next week's about the Fed. And next Friday is the jobs report for July. If that number shows another uptick in the unemployment rate to 4.2%, I don't see how the Fed doesn't cut in September. And quite frankly, they may do it even more aggressively. You may even see a half banger before the year's over if the inflation number also comes in low. So there's a lot for us to track.
I'm going to throw a curveball. By the way, folks, when we do this, there's no net. We haven't practiced or whatever. We're just having a conversation here. So he has no idea I'm going to ask this. I always find these people, they say, this is what they said about unemployment today, but they're always going to readjust the numbers. Talk to us for a second about that readjustment. Is that a big deal? Is that not a big deal? Should we not pay attention to these numbers because they're going to readjust?
100% you have to, because the headline number comes when you see the jobs report has two pieces. The headline number comes from the establishment survey. So last month, 206,000. Yeah. It's kind of like the New York Times saying, and here's why. So that the number comes out and then they revise it lower the previous month. The unemployment rate comes from the household survey. So the obvious question is, how has the unemployment rate gone up from 3.4 to 4.1, which it has over the last year and a half, but we're still putting on 206,000 jobs? Well, the problem is that every month thereafter, that headline number gets revised lower and nobody gets to see it. It's kind of like the New York Times saying, Bill Bodnar, you're a bum. And then 1 month later, they go into the classified ads and say, you know what? We take that back. Bill Bodner's not a bum, but nobody sees it. And so that's what's happening with that headline number. So there's two numbers. The headline number comes from the establishment. This unemployment rate, which is really important, comes from the household survey.
And Bill Bodnar is not a bum. He's sharing us this great information. If you have a question, just throw it over there in the chat box on the side. But we hear it all the time. GDP, gross domestic product. What's this?
Who made these slides? I love this. So GDP came out today. Now, great. It came in at 2.8% for the second quarter. Folks, we're in the third quarter, right? So this is really backward looking. And once again, we got this big number, way beyond expectations, 2.8%. when we were looking for 2% growth. And so now the markets are saying, well, crap, is this thing going to get revised lower like the jobs reports? So there's a lot of noise, a lot of uncertainty, and it's one of the reasons why rates today, as we speak, haven't come down. There's been a bunch of bad news, but then this GDP came in stronger than expected and kind of muddied up the waters. So you have to watch this number, but you have to take it with a grain of salt because it is backward looking. Now, what Steve included is also a thing called the Atlanta GDP Now. What they try to do in Atlanta is try to kind of give us in a real-time look as to where the second quarter and the third quarter, kind of almost in real time, so you can get a more stable number. But even that number, we have seen late revisions, like crazy revisions, like a 1 percentage point decline in like days before like the final quarter was over. So it's not an easy number to pull. And I caution you to say, well, you know, the quarter is going to be great, because remember, GDP over the last several quarters, in the third quarter, it was almost 5%, 4.9. The third quarter, it was, the fourth quarter was 3.5. The first quarter was 1.4. So you could see we're decelerating. And now we're hearing that we're at 2.8. So this has added a little bit of a bump, and it could put pause with the Fed if the inflation numbers. This is where you got to combine all this together when you establish your market position.
We want GDP to continue to rise, correct?
Yes.
There you go. All right, let's hit the next one, my friend. We talk about this. We're talking about debt, debt, debt. Now, this is not talking about my personal debt. Steve's in debt. Steve has to move in with Bill. Bill hopefully has a room over his garage. This is
Right.
talking about debt and how it affects the Treasury. Talk to me.
Yeah, this is a really big one because, and this is something, Steve, that we never, candidly didn't have to worry about until after COVID, right? Right before the lights got turned out on our economy in February of 2020, we had 17 trillion in debt, which is stupid. But now we have 35. So we've amassed 18 trillion more. And, what is even Fed Chair Powell, who tries to stay out of fiscal policy, said, the debt that we have is not unsustainable, which I, disagree with. But what he did say is that the trajectory of new debt is unsustainable. Putting on $1 trillion of fresh debt every 100 days is crazy. And so the reason why it's bad for us in the mortgage business is because it's inflationary, right? You're just throwing money around that we don't have. It's deficit spending. We don't borrow it. We have to sell it. And then when you sell the debt, right, how does the government get this money? They have to sell bonds every 2 weeks, 10-year notes, 30-year bonds, 7-year notes. And if the bond market says, hey, I'll buy that debt, but crap, you guys have to get your fiscal house in order. You're going to have to give me a higher interest rate. There's just no way that mortgage rates come down, right? Because remember, the Fed was the buyer of last resort in the past. They're not buying bonds. They're trying to get rid of them. So it's somebody has to buy the paper. And so, and I'm talking about longer dated paper, short-term paper at 5%, people are diving in. But the risks to take a 10-year note, beneath 4%, we're not seeing it right now. So, and then next week, we do get this big number. Next week, they give us how much money they're going to need to fund the government for the third quarter. And if that number comes in above expectations, the bond market could have a really bad day. And the opposite is true.
Which then leads us over here to, and you threw this one to me. You're like, Steve, I want to talk about oil. What's
Yeah.
oil have to do with mortgages, baby?
Well, this is an easy one. This is an easy one. And by the way, this has been around for decades. This just kind of reminds us of where we are in the market. We always talk about these things that we got to do in these shiny objects. It's all the blocking and tackling. When you look at economic indicators, we just talk about 5 or 6 things. Well, if you looked at just one, oil and mortgage rates meander together because oil is indicative of what the economy is doing, where it's headed, kind of like Gretzky with the puck, and it's inflationary. So if oil prices are going down, it's showing that demand is weak. It's showing that inflation pressures are coming down. That's everything mortgages like. So watch oil very carefully. If it goes up, that's why you got to look at policy. What's going to affect oil prices. All of this stuff is really important.
So they're twins. Oil goes up, mortgage rates go up. Oil goes down, mortgage rates go down.
Bingo, 100%.
And where do I love this. You said, look around. And of course, I always want to represent both sides of every argument. But when you say look around, what are you talking about?
I'm talking about, you hear things, and thanks for the slides. Perfect. You look around because everybody will say things. There's always an axe to grind on the political side, even the fiscal side. Janet Yellen will say things to make an administration look good. Powell will try to job on the market in a certain way. But look around is what's happening. And when you see Starbucks having to enter the value meal deal, like I can no longer sell you a $5 cup of coffee without pairing it with a scone, it's hitting the fan. It means consumers are tapped out. I have to entice you to get into the shop. And all you hear about is, holy crap, when did McDonald's become a luxury item? And now they're all fighting for these value meals. It's because the consumer's tapped out. Now, why is that important? Because the consumer makes up 2/3 of GDP. If the consumer stops spending, GDP drops off a cliff. And by the way, what we didn't mention on that GDP, a recession is 2 quarters of back-to-back zero or negative growth, meaning that the country actually contracts from previous quarters. So that's what we're watching for going forward. But yeah, you have to look at this stuff. I mean, you see layoffs happening. These are critical.
2 left, and I'm looking at my time clock, baby. So let's get it. Stocks and bonds. What am I looking for that for mortgages?
Well, stocks, interesting little data point. Stocks, it seems kind of crazy, but over the last lot of years, several decades, stocks do not do well after the first rate cut. Now, all signs are Fed's going to cut next month, right? If they do, on average, stocks do really poorly over the next 9 months. Well, where's the money going to go? It's that seesaw effect. I'd like to think that some of it's going to find the bond market, especially if the economy's slowing down, threats of a recession. So you got to watch what stocks are doing. It doesn't always mean stocks go up, rates go up. But I will definitely say the way, after a big rally in stocks and due for a pullback, that could help us in the bond market and interest rates.
And of course, we live in the world. We don't just live in the
Oh,
United States of America.
absolutely. And just this morning, China cut interest rates because of their slumping economy and miserable housing market. As countries around the globe perform, outperform, or underperform, that raises rates, lowers rates around the globe, and the bond market is global. It isn't just like the stock market. There's a fight for global yield. So I can either buy a 10-year note, or I could buy the German Bund, or I could buy a Japanese government bond. So you know how these countries perform, and they cut and hike rates. You have to watch it all. It isn't it it's very important, and this stuff affects you overnight as you get into your next day. So it is important.
Folks, I love the fact that he said Bund when it comes to Germany. That's Bill Bodnar. If you want more information, you want to follow up, you want to track the MMG, there's his information sitting right there. My name's Steve Richmond. If you're trying to figure out how to pull all this stuff together, I got a coaching company, Blue Wolf Coach. We'll figure that out for you. I hope you have a great day. Cheers, everybody. Thanks, Bill.
Thank you, pal.